How many of you heard that the Trump tariffs are going to increase the price of housing, increase the price of, home building goods, or, increase the mortgage rates? Well, I have Logan Mohtashami today. He's a HousingWire analyst, featured on CNBC. He's also on the HousingWire daily podcast twice a week, and he gives us the truth on what Trump's policies might do for housing and the housing market. He also gives us a look at the 2025 forecast for the housing market. So enjoy the podcast. Logan, welcome to the podcast. I really want to talk to you today about the housing market for 2025 and how Trump's tariffs and some of his economic policies might impact the market next year, and what real estate professionals and leaders need to understand about what's going on. So let's get into it.
Yes, and for me, I always take my yearly forecast very seriously, and I always do this very Dr. Frankenstein kind of model for each thing, and I try to incorporate everything that could possibly happen to the economy as much as it is could impact housing. So what occurs is that mortgage rates, and how I do it is I channel the 10-year yield. Mortgage rates should be in a range between 5.75 to 7.25. And that's the same forecast I gave in 2023, 2024, because where Fed policy is at and where the economy is at, that's should be the range. And for the most part, that occurred in 2024. What is a benefit for housing, which was this year and should be the case next year, is that the mortgage spreads are getting better. And that was one of the things that, I try to focus on in 2024. And today's a really good example. If we took the worst mortgage spreads, which means, the difference between the 10-year yield and the 30-year fixed mortgage, today mortgage rates would be 7.80%. If I took the worst levels of 2020, today it's at 7%. So it is a really big deal that things got better, and there's still a lot of room for improvement. As the Fed cuts rates and volatility becomes less and there's less early payoff risks, the spreads should improve. That means we don't need the 10-year yield to go down too much to get mortgage rates towards 6%. And towards 6% is the key. Both at the end of 2022, early 2023, and the mid part of 2024, when mortgage rates get down towards 6%, housing demand grows. It isn't a lot, it isn't booming or anything, but we see growth. And when you're working from the third record lowest levels of sales ever, it doesn't take much to move the needle. So same kind of trend forecast for 2025. If the economic data gets weaker and softer and the labor market gets softer, 10-year yield can go down. If the spreads improve, that's the double whammy effect. That's how you get low 6% mortgage rates, and that'll be good for demand.
So let's stay on that topic, because I want to talk to you about, the tariff situation, because from what I understand, Trump wants to raise tariffs. And the whole reason for doing so is to then bring these companies back to the United States. And that's how we're going to make up for the higher prices, I guess, or we're going to lower prices that way. I need more of an explanation and how it may affect mortgage rates.
I actually went through this same thing in late 2016 and early 2017, trying to explain. I do not believe Trump will go into a kind of a big trade war. And the reason I say this is that back in 2016, he said the same thing. He didn't go into the what I call a trade war tap dance. It's a calculated trade war. It's designed to create an atmosphere to try to get companies to come back. He didn't do this until after his corporate tax cuts were in. Rates were somewhat more stable. And then in 2018 and 19, that's when he went into this trade war tap dance. The one thing that didn't happen for him, which I believe his team understands now, is that back then, a business investment, even with a corporate tax cut, just simply collapsed. And a lot of people are talking about negative job revisions in the recent jobs reports we had. We had worse negative jobs revisions back then because companies just weren't sure what the rules were. So a lot of businesses just stopped investing. The economy still expanded, but the markets were back and forth. So I don't buy into the full on trade war because that isn't his MO, especially now with job growth slowing down and with rates elevated. He's probably going to find another time to really go into this, but a full blown trade war can create a little bit more chaos than he probably wants right now. So I think let's wait until let's see something gets signed in, because what happens is if you put a tariff on a country, that country does a tariff right back on you, and it becomes a big, back and forth fight. So to me, I've always thought it was more of a bargaining chip to try to get companies to come back in, but a full-blown trade war, we didn't really even see that in the last presidency, and we don't really have the best backdrop right now to incorporate something like that unless other things come into fruition. So I think the first year, especially going into 2025, it's going to be a wait and see until some things get in place before we go into a kind of any kind of full-on trade war or tariff war out there.
So the rest of his economic policy, I know we've been through it once, but I feel like he's learned a lot as well. He's putting different people into high level positions than he has in the past. First of all, what do you think about personnel change at the Fed? I know he supposedly can't directly do that, and I know that there's talk that he'll stay, the Fed chair will stay until his term is up. But tell me about what Trump's economic policy means for housing.
So President Trump needs the dollar to go lower, and he needs rates to go lower. And why does he need the dollar to go lower? If you want to be an exporting country, your currency has to come down. Right, the dollar is simply too strong for us to be kind of any kind of exporting powerhouse. So in that context, lower rates do benefit him. Now, I would tell you this: his former Treasury Secretary Mnuchin came on TV and have already said we would like to have a cap on the 10-year yield around 4.5%. So I'm already seeing the groundworks of trying to see if they could just talk the rates to come lower in this context. However, he cannot fire Jerome Powell, and Jerome Powell is going to stay until 2026. Who he picks for the next Fed chairman will be interesting to see if he is in line. I can give you guys a really good example. Before he wanted Judy Shelton, Judy Shelton's considered like a gold bug and would be very aggressive in probably keeping rates elevated, but she was very willing to cut rates in a time where a lot of people said you shouldn't, just to help Trump's policy. So when that time occurs down the line in 2026, seeing if he picks one of the people that might invoke, that's a time where maybe the trade war, tariffs can pick up a little bit more steam because he's going to try to get the tax cuts extended, and he needs a little bit of better backdrop so he can get the dollar lower and rates lower, so he doesn't have to offset. I think one of the things I've always tried to teach with about economic cycles: when residential construction workers lose their jobs, it is the front line of every recession we've seen in recent modern day history. Take COVID out of the equation. With rates elevated and housing starts at recession levels and permits at recession levels, it's not an environment for the market to take on even higher rates in that context. So he doesn't want to deal with construction people losing their jobs and then no building is being done. And that again goes against fighting against inflation, because the best way to fight inflation is supply. You need more housing. Probably at a better point later on when rates are lower, he might go into that. So I think trying to get the dollar and rates lower would be to his policy agenda, but he can't necessarily force Powell to cut rates or do anything to get long-term rates lower.
Well, it sounds like the only people losing their jobs will be government people with the new Doge office. So,
yeah, and that is, again, the majority of all government spending is mandatory payouts, and is just simply cannot we can't cut enough really to make up the difference unless you touch Medicare and Social Security. And because we have an aging population, demographics is destiny, right? We have so many mandatory payouts, and every year that goes on, we just add into that. I don't know if cutting enough is going to do anything in bringing the Treasury supply lower to make a big difference. Or do I think he can replace the income tax with tariffs just because of the volatility of how revenues could come in, because one government will do a tariff and then the business cycle? That's a little bit too chaotic anytime soon. So for 2025, you just kind of want to don't worry about that situation and really focus on what the economic cycle is doing right now. And the economic cycle, job growth is slowing down. The economy is still growing somewhat above trend. Household balance sheets still look good because so many homeowners have very low rates. But it's one of these things where any kind of shock in the system can turn economic data weaker. And at this point, probably nothing too extreme should come out in 2025. But time will tell. We're early in this process, and we'll see what programs could be at hand. But if we were running off of his 2016 playbook, he kind of waited until his time, and then he kind of went into a tactical, or how I call it, trade war tap dance. And by the way, in the second half of 2019, after some deals were being made, the markets kind of felt a little bit better, and economic data was actually getting better toward the end of 2019, the first 2 months of 2020. After they signed deals with China, the data had improved right before COVID. So we do have somewhat of a playbook to try to model out what Trump is really thinking, because what somebody says during running for election and what they do officially might not be 100% coincide timing wise.
Yeah, absolutely. So let's talk, the rest of your housing market forecast, inventory, home prices, home sales. What do you predict for 2025?
So if mortgage rates get down towards 6%, we can grow home sales. We can have monthly prints that add about 321 to even, or 373,000 to 621,000 throughout the year if rates get down to 6 and stay. And here's a good example. At the end of 2022, mortgage rates went down to 6%. It gave us one of the biggest home sale prints ever in history. We almost had 500,000 in 1 month. So there's demand there. What's happened is that now that we're in the third calendar year of the lowest home sales, we have a lot of people just sitting there waiting. So if rates go lower, we can get growth in sales next year. That's not a problem. Where sales can be limited or even go negative if it is mortgage rates above 7%. We have enough data this year. What I've seen is mortgage rates between 6.75 and 7.5% didn't really grow the purchase application data any, and sales trends were starting to trend negative. However, 6.625 to 6%, positive data, right? Growth. And on our pending contracts data, we're showing year-over-year growth still toward the end of this year. So that's a positive sign, but we always have to remember, we're working from such low levels of sales. It doesn't take much to get that initial burst in demand and have it stick. Now, lower rates will do it. I think the one period in time in history I could model this out is the early 1980s. The early 1980s, we had home sales crash. Home prices actually grew faster from 1977 to 79 than 2020 to 2022. In this context, back then, affordability was worse. We had more inventory. We had a recession early there. Home prices didn't fall, but eventually when rates fell 2.5%, buyer demand picked up, right? Because you're working from such a low level. That's what I'm looking for in 2025. Can we keep rates long enough, low enough and long enough to get growth in sales, which really isn't saying much when you work from such low levels, but we're seeing the front lines of our pending contracts data toward the end of the year really firm up, and rates are no longer volatile. We're not going 6.5% to 8%. The spreads are getting better. So I'm excited for 2025 in that. But again, what ruins this is what's ruined the last 2 years. Whenever we have growth and rates just shoot right back up, it becomes somewhat problematic to grow sales from there. But Every year that goes on, wages grow, household formation grows, nested equity grows. There's more, most sellers are buyers who get a down payment. We're seeing down payment data start to get better and better over time. That means there's a lot of, I think, $35 trillion of equity in housing. Since most sellers are buyers, this is how you get 5 million total home sales, even in 2023 and 2024. The affordability crisis doesn't really impact the buyers that are in here. All we're missing is about 1 million mortgage buyers from like what we usually have in the previous decade with total home sales. You get rates to go lower, we can grow sales next year.
So let's talk about equity. And, I know that you are not a proponent of the mortgage lock-in, correct?
I have never been a fan of the mortgage rate lockdown, and I have data now to prove it to everyone. So our active inventory data got down to 240,000. And in that context, inventory was simply too low. We had too many buyers and sellers working in together, and home prices were escalating out of control. So what happened is when mortgage rates rose, total active inventory grew in 2022. Then mortgage rates fell toward the end of the year, and it took a while to get the seasonal bottom in 2023. But then rates went up in 2023 toward the end, and inventory grew then, mortgage demand. 2024, inventory grew. We have a lot more inventory now than we had in 2021, but we're missing millions of home buyers. So the mortgage rate lockdown was a theory that if rates are still elevated, nobody is going to sell their homes. Inventory can't grow. Not the case. Inventory grew this year. Mortgage demand, I think a simple way for me to explain this is 70 to 80% of home sellers are buyers. So inventory is a wash. There's one group of people that buy homes that don't give you a house. It's a first-time home buyer, or millennials, or Gen Z. So they gobble up a lot of the remaining inventory, and then throughout, many decades, inventory falls. Well, when mortgage demand isn't really growing, inventory can breathe and get up higher. So I'm the best story for me in 2024 is that inventory was able to grow the whole year. Now we're at the seasonal decline period. And because of that, we're absolutely in a better spot. There's more choices. So when mortgage rates come back down, we don't have to have, 40 or 50 people bidding on the same home. It's a more healthy environment. And this was all caused because higher mortgage rates, days on markets grow, inventory breathes. We got it. We're at a good level. There's parts of the country that are already at 2019 inventory levels. Right now, the pre-COVID inventory levels were perfectly fine. And that's kind of the goal for the nation. So we're almost there. I mean, to me, we're almost at a balanced marketplace. There's certain parts of the country that have no inventory growth, where it's terribly low, like Chicago. But there's other places, Florida, Texas, Denver. There are places where inventory is at 2019 levels, and all my low inventory talk goes away when anybody is at 2019 inventory levels, because we had a functioning marketplace in the last decade.
So what should, real estate professionals be looking for in the market to kind of help guide them about what their plan should be in 2025?
Well, number one, if you follow the tracker every weekend, you know exactly what's happening along ahead of everyone else. To me, it's for every real estate agent, what we've always seen is that mortgage rates getting towards 6% gets buyers in there. So you're going to have to talk to your sellers and their buyers that Mother Economics isn't going to wait for you, right? And it's not one of these things to where you could just go, okay, call me when rates get down and it takes 2 or 3 months. You got to get your sellers and buyers ready to go because everyone else kind of is in that moment, and facilitate a plan that when you get to those levels, you could get a little bit more transaction volumes. That means you'll get more sellers listing, you get more buyers ready to buy in that context, and you get a little bit of growth in sales in 2025. The counter to my thesis is that rates stay elevated. The Federal Reserve doesn't feel like being more dovish, and then sales growth goes nowhere. But we're already seeing little glimpses of better demand. And just remember, heading just towards 6%, you don't need 3%, you don't need 4%. Just heading towards 6% gets demand going again. And it's your job as an agent to get people ready and good to go, because what happens is boy, the market can turn rate wise very quickly. And I think just getting people prepared, if that happens, then they could get into the whole process of selling their house, buying a house, or just simply buying a property.
So I know that Trump hasn't addressed affordability directly that I know of. Do you foresee any type of incentives to get first-time home buyers into houses from this administration?
So there's no plans officially out there. I think the president talked about if we bring oil energy prices lower, everything else follows through with that. There's two ways to help affordability. Number one, rates go lower. Okay. Your house payment becomes less and it becomes more affordable. Very simple. Or you build a lot of homes. Building a lot of homes right now, housing starts at recession levels. Permits are at recession levels. Rates are way too restrictive right now to keep policy like that. So in this context, we cannot expect a lot of construction to be built until rates come down. So the fastest and most easiest way would be rates falling and housing becomes more affordable in that way. People will say, well, home prices will rise. Well, home prices have been rising since 1942, right? You take 2007 and 11 out of the equation. We only had one negative year post World War II, and that was 1990, and that was only by 1%. You can't live in a life where you go, we can't have rates fall because home prices and housing will be less affordable. No, that is not the case. Rates go down, payments become affordable, demand picks up. So there's nothing yet in full details from the administration, but the only two things that could ever work is lower rates, make housing more affordable, and then more construction. And the construction, we're just nowhere. We're not, permits are at recession lows, starts are recession lows. That's even if rates fell, it's going to take some time to build. It takes a while to build housing. So we're actually finishing up on some projects that we started 18 months ago. So it's just one of those things that we just simply can't build homes fast enough to dent anything in 2025. So it has to be rates, or they come out with a program, a tax credit or something like that in that nature. But right now we don't have anything to speculate on.
What about, regulatory changes? I know that he is big on cutting the red tape, especially for home building. Could that increase construction?
Not in 2025.
Yeah.
Regulatory can help, but this is my always debate with my friends who want more housing construction. Monetary policy is too tight. So that's just the way it is. People just say that we're going to build millions of homes. And I always go, you're so adorable. It's so cute. It's just not going to work. Why? And then you show them the housing permits data and they're like, hey, wait a second. Why are permits at recession levels? Because the builders build to make money. I always talk with Sarah. Sarah, what are the builders? They are not the March of Dimes. They need money to build these things. So regulatory can help, but it's going to have to make sense financially. And this is why apartment permits are at recession levels. The cost of capital is so low. This is why one of the reasons I talk about you need a lower dollar and you need lower rates to make this stuff work. So regulatory is one thing. Unless it really hits onto the bottom line, don't look for any kind of housing construction boom with rates still this elevated. And the data we show this and we see this. When mortgage rates head down towards 6%, the builders all of a sudden get more confident and permits can grow. But until that happens, I don't think the regulatory thing moves the needle with rates this high.
Okay. Any last words for our audience about 2025?
So one thing that we've obviously all learned in the last few years, we don't listen to crazy YouTube people about housing price crashes. On the national level, I think going into the spring of 2025 will be very useful. So you want to track our weekly tracker data. We got the new listings, the active inventory, the price cut percentages. And because inventory is elevated from the recent lows, it'll be a spring that has more choices. And as long as the new listings data looks pretty normal, the last 5 years, it's been the lowest levels ever recorded in history. We did have some growth this year, a little bit shy from what I wanted. We could get something of a normal housing market in 2025 where we get more sellers that are buyers and they already feel more comfortable wherever rates are at, that they can sell a home and buy another one. And until we see the new listings data take off, the credit stress data in America looks excellent. Like I just did the revamps of the charts. Foreclosures are down quarter to quarter. Delinquencies are not even back to pre-COVID levels. So we don't have anything of scale on the credit side. The parts of the country like Texas and Florida, where over 40% of all the inventory growth comes in those two states, you want to keep an eye on them because the supply and demand equilibrium is a little bit different there in those two states versus everyone else. But outside of that, the housing market in the construct is still intact. You just need lower mortgage rates to get more demand. Everyone does a little bit more business in 2025. And we'll worry about any kind of tariffs or tax policies once we get something written and signed and done. But until then, don't speculate on that. Focus on the economic data. Softer economic data is beneficial for housing. But in this case, we're already seeing very firm pending contracts data, which we didn't see the last 2 years, even with elevated rates. So we're working from such low levels. We have over 337 million people, over 162 million people working. Millions of people buy homes every single year. There's a good potential for growth this year, which wasn't the case last 2 years because rates stayed elevated.
Great. And for those of you looking for the Housing Wire tracker, it is on housingwire.com. And Logan is also on the Housing Wire Daily Business Podcast twice a week with Sarah Wheeler. So look for him there as well. Thanks so much, Logan. I really appreciate all your insight.
It is a pleasure always being here, Tracey.